Hi everyone, welcome back to my channel. Okay, so today's video is really informal. It's really just me sharing my story with y'all and going into details about the losses I took early on when I first started trading. So most of y'all probably know I started trading 5 years ago, but I've never really shared my story about how it all began. So I'm just going to provide some insight while also telling y'all about some of the L's I've taken. That way you can completely avoid them if you're a new trader. Because full transparency, I'm not out here winning every single trade. My win rate is 87%, and that's not bad, but it could be better. But again, I've only been trading for 5 years, so losing 13% of my trades isn't a huge deal for me personally. And the reason being is because I always know what I'm willing to risk losing before I enter into any trade. I know exactly how much I stand to lose, so I never worry about taking L's because they're usually minimal and it's not enough for me to be super concerned about it. Now, I have lost money, but I've never depleted my account. I was always mindful enough to exit a trade if I saw where it was headed and it was not in my favor. I would always make sure I cut my losses pretty early. So to give some backstory, I have Tesla pulled up here on the chart as y'all can see. And of course, it's in Thinkorswim. I get questions asking, what do I use for a platform? This is Thinkorswim. So the reason I have Tesla pulled up here on the chart is because this was actually my first loss that I took when I first started trading. And I do remember the exact amount of money that I lost. It was $421. And at the time, I was very new to options trading, so I made so many mistakes. So I'm going to show y'all recreating this scenario on today's charts because ironically, the trade I remember taking was a bit similar to what you see here. Now, I don't remember the exact setup because obviously that was 5 years ago, so it's a rough simulation of what happened. But essentially, I was putting in a play for calls on Tesla. I really thought I knew what I was doing because my strike price was in the money, but I didn't have a stop loss set. One, because I really didn't know what a stop loss was, and two, because I didn't know how to set one for real. And then also, needless to say, I didn't know how to read the charts. So y'all are probably thinking, okay, so why did you even enter the trade? And the answer is, I just thought I knew what I was doing. And at the time, I was watching a ton of different YouTube videos. I was in a few trading communities on Discord, and I was evaluating those educational videos that TD Ameritrade and Fidelity offer. So honestly, you couldn't tell me nothing at the time. I thought I was doing what I knew was going to be profitable. And I was convinced that I would make money immediately. And of course, it didn't work out that way. So let me break down exactly what happened. So first, I was looking at the high of the day. I thought I was analyzing the charts correctly. So that's why you guys can see I have the high pulled up here. So my first mistake was that I missed the break and retest. I entered Tesla calls, but it was at the wrong mark. So Tesla didn't hold the level above the price that I thought it would, and it bounced. Now, mind you, I had no stop loss set at all. So the candle opened lower than the average volume, aka the VWAP. So this wasn't aligned with the strategic price level, which means it wasn't in sync with how to actually evaluate a play for calls. And at the time, the stock was holding for a second, but with low open interest and volume. So the momentum just wasn't there to really have motion, and I mistimed the entry completely. So now that we have a little backstory, I want to go over some of the information to help ensure that y'all don't make the same mistakes that I did. Okay, so just to kind of provide some context, let's say for example, I was looking at this particular time frame, right, at about 9:28, 9:30. I was looking at the setup, I had the RSI pulled up, and I saw that the stock was dropping. Okay, so in my mind at the time, I was like, okay, the RSI shows that the stock is pretty low, so that's telling me that the stock essentially has been oversold. So I'm thinking to myself, we know the stock has to eventually go back up. So for me, at the time, again, not fully understanding the charts, I was looking at the bounce and I was thinking, okay, the stock will pull back and of course it'll have that break and that retest and it'll go back and we'll see an uptrend. However, that did not happen. What happened was I entered into the play, let's say about 9:32, right, at this candle here. And you can see where the volume is. Now, at the time, I wasn't fully aware of what the volume fully meant, so I entered into the trade with very low volume, very low momentum, and the stock continued to drop and drop, and it fell, and it continued within that downtrend. Essentially, I was like, wait a minute, I thought the stock would rise back up because the RSI is so low. But that was the only thing I was essentially using at the time. I had no other evaluation, no other means of analysis. It was just me going off RSI. So with that being said, I ended up losing money because, of course, the stock just continued to drop. There was no confirmation that I really had that the stock would actually make a play for calls and that the stock would rise. It was just an evaluation of what I thought I knew, right? So again, that was my mistake. But I want to go ahead and go into detail about it because this is just an overview of what I thought I saw. But I want to break down each kind of like pattern or like the candlestick motions and then also show you guys what it looks like to actually enter into an uptrend the correct way. Okay, so this infographic you see here explains the psychology behind candlestick patterns, and those are going to be visual representations of the price movements in a trading session. Now, at the time, I had no clue how to understand market sentiment through different candlestick formations, so I want to discuss this first. So to break this down, what we see from left to right is the first thing is going to be the attempt of sellers to push the price down during a bullish session. This shows us that the candle is green and it means that buyers had control, but the presence of an upper wick shows that sellers tried to push the price lower during the session. However, buyers ultimately prevailed, pushing the price up before the close. So I had no clue on how to read this 5 years ago. So moving on, when you see the attempt of buyers to push the price up during a bearish session, this shows a red candle showing sellers in control, but the lower wick indicates that buyers attempted to push the price higher. However, sellers maintained control and closed the session lower. So moving on, we also see that buyers can push the price heavily higher during a session. Now this red candle has a long upper wick, and this signals that buyers have pushed the price higher at some point during the session. But nevertheless, the sellers regain control and close the session lower, indicating that strong selling pressure. And then on the other hand, the opposite is also true when sellers push the price heavily lower during a buying session. So despite the candle being green, the long lower wick shows that sellers temporarily pushed the price much lower. However, buyers recovered the session and pushed the price back up, showing that strong buying demand. So these are the key things to keep in mind when we look at the trading pressure, some things that I had no clue about 5 years ago as mentioned. So I definitely want to make sure if you're a new trader, you have full understanding of these basic concepts. Now, I often get asked by new traders essentially what the wicks mean, and I definitely want to go over that really quick. So the wicks are basically the shadows, and they indicate the price fluctuations during the session, and it's an attempt by the opposing force, either buyers or sellers, to change the direction of the stock. So this breakdown, it helps provide and analyze the price action to determine who is in control of the market. Is either, of course, going to be those buyers or sellers. It's supply or demand. All right, so next up, I want to highlight the key indicators that traders can use to identify optimal moments to buy in an uptrend market. So one of the first key elements to identify on a chart is going to be a strong uptrend. So the price is consistently making higher highs and higher lows, and this signifies a strong upward trend, of course being bullish, meaning that you would be able to confirm this simply with just using a trend line for support. And of course, if the stock continues to bounce off that support level, that's going to show you directionally what the stock is doing. Now, moving on, talking about the trend line, this of course is that diagonal line you guys see drawn, and it's connecting the lows in the uptrend, which acts as that support level, and this confirms the market's upward momentum. Now, when we look at the support zones, these are going to be those horizontal lines where the price has previously bounced upward. And this indicates areas where the price is more likely to rise again after dipping. And then when we look at the trend line and support confluence, these are going to be points where the price touches both the trend line and the support zone, and this offers strong confirmation for buying opportunities. So these areas represent a combination of technical indicators, meaning the trend line and horizontal support, and it helps to reinforce a potential entry point for these buying opportunities. Now, another confirmation can also be presented within the form of the massive bullish candles. So these chart marks represent specific areas where large bullish candles appear, and these large candlesticks show strong buying momentum, and they also act as signals to enter a trade when aligned with support and trend line confirmations as well. So you can't have just one, it has to be a combination of them. So with this image, it suggests that entering a trade when the price reaches a support level near the trend line and is followed by a large bullish candle, this is going to indicate that strong pressure and a continuation of the uptrend. So when you see this on the chart, you'll pretty much be able to break down the technical pattern to give you that confidence for the entry. And the whole aim of it is to reduce the risk by following the price action in alignment with the support zone, and then also, in addition to that, adding the bullish momentum. Okay, so the last thing I want to go over to make sure that everyone can avoid the mistake that I made, which is going to be understanding how to properly read a falling wedge formation. So this is going to be formed by two downward sloping trend lines that converge, and it's with the price bouncing between the lines and getting squeezed into a tighter range. So you can see that here on the screen. Now this pattern indicates that the bearish momentum is weakening. So with that being said, you can see the upper trend line. This acts as that resistance line for the price to touch multiple times if you see it, but it doesn't actually break through during the downtrend. And as you can see, this upper trend line, it slopes downward more steeply than the lower trend line. And what this does is it offers that support line where the price follows, and it represents a decreasing pace in the selling pressure. So when we look at the entry breakout for this candle, the chart shows that the price eventually breaking above the upper trend, which is the entry point, as a signal of a buying opportunity. Now, this suggests that entering the trade on the breakout candle with a tight stop loss is going to be necessary because you want to make sure that just under this candle, for your risk management purposes, you're not being subjected to a false breakout. Now, within that, you also want to look at your take profit targets and be very strategic within that. So you can have it a point where traders can see a secure partial profit after the first breakout. And then you can set your second take profit target a bit higher if the price continues to rise. And then your ultimate take profit target should be just above where you see essentially that trend line. And this is going to be the final price target based on the height of the wedge. Now, this indicates where the price may rise after the breakout. Now, of course, you can stay in the trade above this level, but it's best not to allow greed to take over. So most likely you may want to take profits and exit completely. Now, the reason I did want to mention this falling wedge pattern is because this strategy can be applied to any chart time frame, and it goes from intraday to daily and weekly charts. Now, we also see a bullish pin bar formation at the wedge's lowest point on the chart, and this hints and signals as a reversal, and of course it's going to be used to confirm the breakout. Now, if I would have had this information 5 years ago, I would have been fully aware that the falling wedge, these breakouts are described as aggressive and highly profitable because they often result in a sharp upward momentum because of the movements. Now, with that being said, you can also spot this pattern early and position yourself for a breakout, essentially timing the market just right if you know what you're doing. And you can look for the price breaks above the upper trend line. Of course, you want to set a tight stop loss under the breakout candle, and then your profits are secured at multiple points as the price rises up. And I just want to emphasize that with experience, you can better spot these setups and potentially achieve earlier entries for higher profitability. But again, that's something that comes with time. And with that, that'll pretty much do it for this video. So yeah, I hope y'all enjoyed learning a little more about my story and my early trading experiences. If you found any of this information to be beneficial, feel free to let me know in the comments below. And as always, I thank y'all so much for watching, and I'll see you in my next one.